Somewhere right now, a bank is paying you 0.4% interest on your savings account. The same bank is lending that exact money out at 24% interest on a credit card. That's not a glitch. That's not an accident. That is the entire business model, working exactly as designed. You put your paycheck in a building with marble floors and a security guard, and you call that safe. What you don't realize is that the moment your money lands in that account, it stops being yours in any meaningful sense. It becomes raw material, inventory, and you become the unpaid supplier. By the end of this video, you're going to understand exactly how that inventory gets turned into a $300 billion a year industry profit machine. And once you see it, you won't be able to unsee it. Here's the uncomfortable part. This isn't a story about greedy executives twirling mustaches in a boardroom. It's a story about a system that has been quietly perfected over 200 years, and it works better today than it ever has. Because today, most of it is invisible.
You don't see it happening. There's no moment where a banker walks up to you and says, "I'm about to make 40 times more money off your paycheck than you will." Instead, it happens through an app, a push notification, a reward, a convenience fee, a number that looks small enough to ignore. In 2023 alone, U.S. commercial banks reported combined profits north of $250 billion. That's not revenue. That's what's left over after paying employees, rent, technology, everything. Pure profit. And the median American household in that same year had less than $8,000 in savings. Those two numbers are not unrelated. They are the same story, told from opposite ends. So the real question isn't, are banks profitable? Of course they are. The real question is, where exactly does that profit come from? And why does it always seem to come from the people who can least afford to give it?
Let's start with the part everyone thinks they understand, but usually doesn't. How a bank actually makes money. The textbook answer is the interest rate spread. You deposit money, the bank pays you a little interest. The bank lends that same money to someone else at a higher rate. The difference is the bank's profit. Simple enough. But here's the detail that changes everything. Banks don't just lend out your money. Under what's called fractional reserve banking, a bank is only required to keep a small fraction of deposits on hand. The rest, the vast majority, gets lent out, invested, or multiplied through the financial system. Here's what that looks like in practice. You deposit $1,000. The bank keeps a sliver of that in reserve and lends the rest to someone buying a car. That car dealer deposits the loan payment into their bank. That bank then lends most of that out again. 1,000 real dollars can ripple through the system and functionally become several $1,000s of loans, all traceable back to your original deposit.
You still see $1,000 in your account, but that same $1,000, in a sense, is now working in 5 different places at once, for the bank's benefit, not yours. Now overlay the interest rates. In 2024, the average U.S. savings account paid around 0.4% annual interest. The average credit card charged over 24%. That is not a small gap. That is a 60 times difference. The bank borrows from you at 0.4% and lends to someone else, sometimes lends your exact deposit at 24%. If you did that in any other industry, we'd call it something else. Buy for $1, sell for 60. But because it's wrapped in the language of accounts and rates, it feels normal.
Here's the part most explainer videos skip, because it's less flashy than interest rate spread. But it's actually where a huge chunk of bank profit hides: fees. Not headline fees, quiet ones. Overdraft fees. In 2022, U.S. banks collected roughly $7.7 billion just from overdraft and non-sufficient fund fees. Think about what an overdraft fee actually is. You spent money you didn't have, usually by $20 or $30, and the bank charges you $35 for the privilege of covering that gap for less than a day. Annualized, that's an effective interest rate that can run into the thousands of percent. No credit card, no payday lender, nothing sketchy, just your regular checking account, quietly functioning like a predatory lender in a trench coat.
And who pays most of these fees? Not the wealthy. Study after study shows overdraft fees are concentrated among the same narrow band of customers. Roughly 9% of account holders pay about 80% of all overdraft fees. These are, disproportionately, people already living paycheck to paycheck. The system doesn't just fail to help the financially fragile, it monetizes their fragility.
Then there's interchange, the fee merchants pay every time you swipe a card, a percentage that flows back to the bank that issued it. You don't see this fee. You never get a bill for it, but it's baked into the price of everything you buy, which means everyone pays it, including people who use cash, because merchants raise prices across the board to cover it. Then there's float, the days a bank holds your money before a transaction fully clears, during which it can quietly invest that cash and earn a return, using dollars that are, on paper, already yours. Individually, each of these looks small. A few dollars here, a fraction of a percent there. That's the design. Nothing is large enough on its own to make you angry. It's death by 1,000 invisible cuts, engineered to stay just below the threshold of outrage.
Now, here's where the story gets genuinely uncomfortable, because it's not just about old-school banks anymore. The last decade sold us a rebellion. Fintech apps promised to be the anti-bank. No fees, instant transfers, banking the unbanked, round-up savings, cash back on everything. The marketing was, we're on your side, not the bank's. Look under the hood, and many of these apps make money the exact same way, just repackaged. Many free trading and banking apps earn revenue by routing your transactions to third parties who pay for the privilege, a practice called payment for order flow. Others push high-yield boosts that require you to link a paycheck, effectively renting your salary as a marketing tool for a bigger financial institution behind the curtain.
And then there's buy now, pay later, sold as the friendly, interest-free alternative to credit cards. For consumers who pay on time, it can be genuinely interest-free. But industry data shows a meaningful share of users miss payments, and late fees on these plans can carry effective annual rates that rival or exceed a traditional credit card. The pitch is no interest. The fine print is unless you're late, and a lot of people are. This is the irony sitting at the center of modern finance. The industry that caused the 2008 financial crisis rebranded in the years after as the industry that would liberate you from banks. And in doing so, some of it just built a faster, shinier on-ramp to the exact same destination: your money working for someone else's balance sheet.
Step back far enough, and this stops looking like a story about individual banks and starts looking like a story about the entire architecture of how money moves. The financial system was not built to be transparent. It was built to be trusted. Those are not the same thing. Trust means you don't ask questions. Transparency means you can see the answer, even if you don't ask. Banks have spent a century cultivating the first while quietly avoiding the second. And the long-term risk isn't just that individuals lose a few $100s a year to fees they didn't notice. It's that an entire generation is growing up financially fluent in spending, tap to pay, one-click checkout, buy now, pay later, while remaining almost entirely illiterate in how the underlying system profits from that fluency. Surveys consistently show most American adults cannot correctly answer basic questions about compound interest. That's not a coincidence in a system where the majority of consumer profit is generated by compounding, just in the bank's direction, not yours.
There's a wealth gap conversation happening in almost every country right now, and it's usually framed around wages or housing or inheritance. Those matter, but there's a quieter contributor sitting underneath all of it. The wealth gap is partly a fee gap and an information gap. The people with the least financial cushion pay the most in overdrafts, the highest effective interest rates, and the least favorable terms, not because they're careless, but because the system is engineered to extract the most from those with the fewest alternatives. Meanwhile, the people who already have capital get the lowest rates, the best terms, and the fee waivers because banks compete for their business instead of extracting from it. The system doesn't just reflect inequality. In a real, measurable way, it manufactures more of it
every single billing cycle.
So here's where this leaves us. Banks aren't villains twirling mustaches. There's something more unsettling than that. A machine running exactly as designed, generating record profits not through some hidden scandal, but through thousands of small, legal, well-lobbied mechanisms that most of us never bother to read the terms and conditions for. The 0.4% and the 24%, the overdraft fee that costs more per dollar than any loan shark would dare charge in public, the free app quietly selling your order flow. None of it is a secret. All of it is disclosed somewhere, in some document, in some font size small enough that almost no one reads it. Which raises the question this video can't answer for you. If the system is legal, disclosed, and technically your choice every step of the way, at what point does personal responsibility stop being a fair explanation and start being a convenient excuse for a system that was never built to be understood by the people it profits from most?